Right now, something unusual is happening in the world of retirement planning. Wealthy families are quietly moving millions into Roth accounts. Financial advisors at the top firms are telling every client over 50 the same thing. And CPAs across the country are running conversion calculations like their lives depend on it. They all see the same thing: a window. And that window is 2026. Today I'm going to show you the 5 reasons smart money is converting to Roth right now, and why this specific moment may not come around again. Before we dive in, let's be clear about what a Roth conversion actually is. You're taking money sitting in a traditional 401k or IRA, money that will be taxed when you withdraw it, and moving it into a Roth IRA. You pay taxes on the conversion now, but from that point forward, every dollar of growth and every dollar of withdrawal is completely tax-free. The question has never been whether Roth conversions are smart. The question has always been, when is the right time? And 5 forces are converging right now that make 2026 the answer. Reason number 1. Tax rates are locked in and historically low. In July 2025, the One Big Beautiful Bill Act made the Tax Cuts and Jobs Act rates permanent. That means the 7-bracket system, 10, 12, 22, 24, 32, 35, and 37%, is now the law of the land. No sunset, no expiration. But here's what the smart money understands that most people don't. Permanent doesn't mean forever. Congress can change tax rates any time. And with a national debt over $36 trillion and growing, the pressure to raise rates will only intensify. Today's rates are some of the lowest in modern American history. The top rate was 70% in 1980. It was 50% in 1986. Even in the 2000s, it was 39.6%. At 37% today, we are at the bottom of a historical cycle. Smart money doesn't bet on rates staying low. Smart money locks in the low rate while it's available. That's what a Roth conversion does. It lets you pay the known rate today instead of gambling on tomorrow's rate. Reason number 2. The new senior deduction just created a hidden conversion opportunity. Starting in 2025 and running through 2028, the OBBBA introduced a brand new deduction for Americans 65 and older. It's worth up to $4,000 for single filers and $8,000 for married couples filing jointly. This is on top of the standard deduction. On top of the existing additional standard deduction for seniors, it's essentially free tax space. For a married couple both over 65, we're talking about a total standard deduction that could exceed $35,000. That means you could convert $35,000 or more from your traditional IRA to a Roth and owe little or even nothing in federal taxes on it. This deduction phases out above $150,000 for joint filers and $75,000 for singles. But for retirees in that sweet spot, living on Social Security plus modest income, this is a golden ticket, and it expires after 2028. That gives you 3 tax years to take advantage: 2026, 2027, and 2028. The smart money isn't waiting until 2028 to start. They're converting now while they have 3 bites at the apple. Reason number 3. The government just forced high earners into Roth. Starting this year, 2026, if you earned more than $150,000 in wages from your employer last year, your 401k catch-up contributions must go into a Roth account. Not traditional. Roth. It's mandatory. This affects everyone over 50 making catch-up contributions, and for workers aged 60 to 63, there's now a super catch-up, allowing up to $11,250 in additional Roth contributions. Think about what this signals. The government is pushing people toward Roth. Why would they do that? Because they want the tax revenue now. They know traditional 401k balances represent trillions in deferred tax revenue, and they need to start collecting. When the government starts mandating Roth contributions for high earners, smart money reads the writing on the wall. If they're forcing it on your contributions, how long before they come after the conversions too? There have already been proposals to limit or eliminate Roth conversions entirely. The ability to convert unlimited amounts from traditional to Roth with no income limit may not exist 5 years from now. Smart money doesn't wait to find out. Reason number 4. IRMAA is the invisible tax nobody plans for. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge on your Medicare premiums that kicks in when your income exceeds certain thresholds, and it uses a 2-year look-back. For 2026, if your income exceeded $109,000 as a single filer or $218,000 as a married couple back in 2024, you're already paying extra. The surcharges can add up to over $500 per month per person for Part B and Part D combined. Now here's where it connects to Roth conversions. Every dollar in your traditional IRA that generates an RMD counts as income. That income pushes you up the IRMAA ladder. And unlike tax brackets, IRMAA is a cliff, not a slope. Cross the threshold by $1 and you pay the full surcharge for the entire year. A retiree with a $2 million traditional IRA could face RMDs that push them into the second or third IRMAA tier. That's an extra $4,000 to $8,000 per year in Medicare costs per person, on top of the taxes on the RMDs themselves. Roth conversions before age 73 reduce your future RMDs. Roth withdrawals don't count toward IRMAA. Every dollar you convert now is a dollar that won't trigger those surcharges later. Smart money runs the IRMAA math and converts enough to stay below the cliffs. Most people don't even know the cliffs exist until they get the bill. Reason number 5. The 10-year inheritance rule changed everything. Under the Secure Act, most non-spouse beneficiaries who inherit a traditional IRA must empty it within 10 years. No more stretching it over a lifetime. That means your children or grandchildren could face enormous tax bills as they're forced to withdraw hundreds of thousands in a compressed time frame, often during their peak earning years when they're already in high brackets. But here's the difference with a Roth. The 10-year rule still applies. Your heirs still have to empty the account within a decade. But every withdrawal is tax-free. The entire balance comes out without generating a single dollar of taxable income. For a $1 million traditional IRA, your child inheriting it could face $300,000 or more in taxes over that decade. The same million in a Roth? Zero tax. Smart money is doing the math on their legacy. They're paying the taxes now at their rate so their children don't have to pay at theirs. So how do you actually execute this? The strategy the pros use is called a Roth conversion ladder. Instead of converting everything at once and getting hit with a massive tax bill, you spread conversions across multiple years. The goal is to fill up each tax bracket strategically. In 2026, a married couple's 22% bracket ends at roughly $190,000 of taxable income. If your regular income is $80,000, you have about $110,000 of space to convert at 22% or less. That's $110,000 you're moving from the taxable column to the tax-free column. Do that for 3 to 5 years, and you've converted $500,000 or more at rates that could be half of what your heirs would pay. The key is to start early in the year. Don't wait until December when your income picture might surprise you. January and February are the best months to plan because you have maximum flexibility. Here's what I'd encourage you to do right now. First, find out what your current traditional IRA and 401k balances are. Total them up. That's your future tax liability sitting in a pot. Second, estimate your income for 2026. Social Security, pensions, any employment. Then calculate how much room you have in the 12%, 22%, or 24% bracket. Third, run the numbers on a conversion. What would it cost in taxes today versus what it would cost your future self or your heirs down the road? If those numbers look favorable, and for most people in the 50 to 70 range they do, then 2026 is the year to act. The 5 forces I just described: historically low rates, the new senior deduction, mandatory Roth catch-ups, the IRMAA time bomb, and the 10-year inheritance rule are all active right now. Some of them are temporary, and the Roth conversion door itself may not stay open forever. Smart money doesn't wait for perfect conditions. Smart money recognizes when conditions are as good as they're going to get. If you'd like to see exactly how a Roth conversion strategy could work with your specific numbers, I'm offering free 15-minute strategy sessions. The link is in the description. We'll map out a plan that could save you and your family hundreds of thousands in taxes. Because the smart money isn't wondering whether to convert, they're wondering how much.